Let's get to our weekly wrap. So, recapping what's happened today, but really focusing on the big picture. So, we've talked about this, sort of bear market rally. We're going to start with the chart of the S&P 500 here. And, for me, it's always been about the trend, right? It's about the trend, higher highs and higher lows. That's an uptrend. As long as we continue to do that, then the trend is positive. And if you look at the daily chart of the S&P 500, it's undeniably in an uptrend, right? A series of higher highs and higher lows. That first real higher low, first week in April, was the first of many. The only real concern we've had, if you look at that sort of medium-term time frame, looking at a couple months at a time, is this pullback here in the April-May period. And what we talked about was, is this a bull flag? Is this a big run, a parallel corrective period where we sort of digest those gains? And if and when we break above there, we had the added bonus of being right in this resistance range around 2950 to 3000. This is the 200-day. And if you followed what we've talked about, that break certainly signaled higher highs. It's accelerated to the upside. And I think this has led a lot of people to question the, how long this sort of move can continue. And that's totally fine. I think, again, if you look at the fact that the market's overbought, that could be potentially a short-term negative signal. Absolutely right. But what I would remind you, and this is, if I remember right, I did get a question on this. I don't know if we're gonna be able to get to it in the mailbag segment today, but just because it's overbought just means it's gone up a lot. So if you look back here in mid-November of last year, that was the first time we'd become overbought in about 3 or 4 months. And if you look, it pulled back for a day or two, and then the uptrend resolved. It became overbought again, pulled back for a day or two, and the uptrend resolves. So what happens is, in an extended bull phase, you become overbought and you almost remain overbought. And so it's less about the short-term tactical read. Are we due for a pullback? Absolutely. There's no denying, if next week we had a bit of a pullback to like 3,100, that would satisfy everyone. That would feel like a much healthier move. When we start going vertical, people can get concerned, rightfully so, about how sustainable is that sort of rally. But for me, I found more meaningful market tops are more about divergences, like you saw here in January, February of this year, and less about just becoming overbought. That usually just means the market has gone up a lot. That's kind of where it feels like. So it makes sense to me that the market, that the S&P is overbought here. Let's look at some of the other quick themes, and then we'll get right into our the Mindful Investor Live chart list. So the S&P finished almost to 3,200. It actually was above there earlier and came back to close below 262 on a percent basis is where we ended up. Mid caps, small caps up even more. So the small cap index up 4.4% with the S&P 600 hitting around 900. The NASDAQ 100 up a little less than the S&P, but still up 2%, which is pretty decent. The VIX now below 25, down another 5% today. In terms of sector leadership, energy was really the main story today, with stocks like ExxonMobil, Chevron, and a lot of other names that you're probably that you've looked at up significantly. Big gaps higher with the energy sector, the XLE up 7.5%, followed by financials up 3.8%. So we talked about this emergence of banks. We yesterday had Greg Harmon talking about Cincinnati Financial. The day before, boy, I'm taxing myself to come up with names and tickers we talked about in the week. It's not going to come to me, but other guests this week, I remember we talked about sort of a consistent theme, was talking about financial stocks and what they were doing. So the fact that the XLF is up almost 4% is pretty meaningful as well. On the downside, you have the XLU utilities, we have consumer staples, we have healthcare. Utilities being up the least doesn't concern me a ton. What does concern me is if you look at a chart of the XLU, and I'll show you that here. This is sort of the you call a shooting star pattern, which is basically you rally up, the open and close right at the lower end of the range. You have a big upper shadow or upper stem. So if you're familiar with candlestick analysis, you'd call this a shooting star pattern, which is basically open and close at the lower end of the range, a big upper stem, which means we opened, we traded much higher, we then closed back toward the lows of the day. That on its own is one thing. The fact that it happened right at the 200-day moving average, which was right where the XLU hit resistance in April, tells me to be a little bit wary about the upside potential of utility. So, short term suggesting a little more weakness than strength. This is that the relative strength has turned over a little bit, and as it's facing key resistance. So it really hasn't, we talked yesterday, I think it was one of our 3 and 3 was looking at utilities, and it certainly didn't follow through there today. The other one I would point out on a sector basis is healthcare, and this relative weakening of the healthcare sector. Overall, still up 1.6%, but this is when the S&P was up 2.6%. So, in general, it's not really been driving the market higher. It's been sort of coming along for the ride a little bit, but a lot of the names that had looked much better in the healthcare sector starting to weaken on a relative basis for sure. The other big stories, looking at this this week, and then we're going to get to some other things, are the emergence of some of these stocks like American Airlines, Royal Caribbean, gapping up today in a big way. Sort of these recovery names, travel, tourism sorts of stocks, really rallying. American Airlines was up pretty significantly yesterday. Certainly seemed to follow through today, and at one point earlier in the day broke above the 200-day moving average. But if you look, we closed way back down, almost into yesterday's price range. So this comes as it was overbought, nearing that extreme overbought region, but overbought at the 200-day and not able to close anywhere near that. Sort of speaks to a little bit of short-term weakness coming in. So, again, this group is up huge. The relative strength has exploded to the upside. Today's, sort of trajectory of gapping higher, but then closing back and filling that gap intraday does not usually speak to a lot of strength going on. That feels like a lot of people that got in and took profits on an early gain today. So whether that has staying power is a real open question. A new chart I wanted to put together. I was just thinking of how to best illustrate the relative movements of the different major asset classes, and we went above the viewable area. That tells you how much crude oil was up by the end of the day today. It went off the screen here. But this is basically looking at some of the major asset allocation decisions I would be thinking of and where they all ended up. This is just starting the clock last Friday and just looking at the 5-day returns. And again, don't read too much into that in terms of bullish or bearish outlooks, but it's just trying to define where we came from. So crude oil, the biggest gainer out of all of them, up over 11.5% through today's close. Small caps number 2 up 8%, the S&P up 5%. So it's interesting that on a week that the S&P really improved, really rallied to the upside, small caps up even more. And this is a very different configuration than what we've seen up until recent weeks. It had been a mega cap led move led by those big consumer and really not as much consumer, but more communication services, definitely technology stocks like Microsoft. Look at the relative strength of Microsoft. It's come off quite a bit as other sectors, other groups have really emerged in more of a position of strength. Bitcoin actually at one point led the way on Monday back to finish up around 3%, but really not tripping higher. A lot of these risk on assets did. Bitcoin certainly taking a different track, and the Nasdaq 100 up 2.7% through the end of the week. 3 of these assets were down. The dollar down 1.5%. We talked about some of the weakness in the dollar and the inherent strength in emerging markets, international stocks. I was talking with Ms. Schneider earlier today, a couple weeks ago, had her talking with her about international stocks and looking fairly attractive. So weakening dollar, certainly buying into that thesis. Gold down 3%. This has been one of the better longer term charts, really starting to evolve in terms of the precious metals. And then bonds down the most, down 4.5% about. So certainly this week was more about risk on versus risk off, things like bonds and gold down, the dollar weaker, and all these other risk assets going to the upside, with crude oil leading the way, and energy you saw up the most today. Let's look at the Mindful Investor Live chart list. We're going to start with what I call the market trend model, which is looking at the big picture trend. I run this model on all the major asset classes, but we'll focus here just on equities. So for me, the long-term model is looking at the 21 and 34 week moving averages. It's so close to tripping, and did not get there today. I could see next week it actually tripping positive. The short-term and medium-term reads based on the weekly PPO or the weekly MACD, both have been positive from late March, through early May, which is when the short-term and medium-term trends both turn positive. So both sort of firing on all cylinders. And again, the question is, what happens to this trend? The gap higher certainly surprised me and others, just the resiliency of this uptrend. But at some point between early April and now, I think you had to have seen something that convinced you to turn positive. I really waited overall, and still, again, years from now, this could be the first corrective wave after another big wave down. But in the tactical time frame that I'm paying attention to, you have to acknowledge the uptrend in stocks and its ability to break out above its 200-day moving average on any pullback. 3,000 is the line in the sand that I would hold to pretty well. I think that's a fair a fair object to look at. All the weekly breadth indications, for the most part, that I follow have now turned positive with the strength in stocks, and all 4 of the cumulative advanced decline lines have turned positive in the last 5 to 10 trading sessions, which is really worth noting. And small caps, the last one to break positive, has now done so, confirming the uptrend that we've seen. We haven't updated this yet for the end of the week for Friday's session, but I again have talked about the increasing number of new highs. I'd love to see that continue on. It'll be interesting as we lock in Friday's closing values on all the stocks and see how these update, how much that participated in the uptrend. But I would sense that's probably going to continue to go a little bit higher. You know, looking at breadth yesterday on our 3 and 3, we talked about this chart, the percent of stocks above the 200-day in the S&P 500, breaking above 50%. And I don't know when, but somewhere along this way, I remember saying, as the percent above the 50-day improved so much, I remember saying, look, until we get over 50% of the S&P above their 200-day moving average, I don't know how much staying power this rally is going to have. We're there. It's like I can't come up with any more things we haven't done yet. We've kind of done it. That on its own, I tweeted that out earlier, and the response I got was, you might have called the top right there. I hope not, but maybe. Again, everything's sort of rotating higher. In terms of sentiment, to switch gears just a moment, if you look at the AAII rankings, something I like to look at every week, this came out yesterday, so it's not updated for today, but there's been a narrowing of bulls versus bears almost to the same level. There's only 4% more bears than bulls here. That's down from 30% more bears than bulls just about 5 weeks ago, right? So that's a huge rotation. That was one of the lowest numbers we've seen in quite a while. We're now almost back to the 0 level, and it shows you how much individual investors have rotated and bought into it. Still, though, only half of respondents bullish, or a little under half if you look at the 2 of those. The rest obviously in the neutral bucket. We focused a lot on ratio analysis, so if you missed the episode yesterday, I'd encourage you to go to Thursday's episode to see that. But we focused on things like the relative performance of semiconductors, consumer discretionary versus consumer staples, consumer discretionary versus tech. All of those things I think are very important to pay attention to in terms of this rotation away from mega cap tech into other places that have really emerged in strength, especially finance, especially energy. And I'll finish off by just pointing out that small caps have really rallied in a meaningful way on a relative basis. That is a very different feel than what we've had for quite a while. And sorry, one more chart. I keep saying one more chart. This is honestly the last one. Growth versus value rotating lower. I still think it's a little early to declare the end of the growth trade, but this certainly indicates a rotation away. This is the biggest downturn in this ratio that we've seen in over a year. Has certainly been favoring growth. You can see this is now rotating below the 50-day average for that reading, and suggesting that the value trade starting to emerge as some of these sectors that we've written off mentally are starting to emerge and perform very well. That is our weekly wrap for today. A lot of really interesting charts, and again, a resilient equity market that certainly deserves your attention if you haven't focused there yet.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.